If you're worried about the impact of capital gains on a business sale and selling your business or property, Bob Caples here is going to solve that for you. Bob, excited to have you here. You're the hero of today's interview and story. Tell us a little bit about yourself and what you do before we kind of dig into the details of your solution.
Yeah, of course, Joe. And thank you so much for having me today. I really feel it's a privilege to have this opportunity to visit with you and to share some thoughts about this very exciting and frankly great solution for folks, as you said, that are oftentimes facing very significant capital gains tax exposure, looking to exit a business and or property that sometimes may prevent them from moving forward because of that concern. So yeah, I'm very happy to have this chance to help provide some information that may be some real benefit to folks in that situation.
Great. And I'm very appreciative to have you here, Bob. As you know, and many people do, I'm a business broker based out of Nashville, Tennessee, and often on just intro calls with business owners. It's, oh, well, Joe, if I sell, I'm going to have to pay all these taxes, and then I'm going to have to pay you, and then I may as well not sell because I'm going to pay so much in capital gains
Yeah,
that not even worth it, right? And
that's
so, as
yeah.
a business broker, when you and I met and you were like, oh, yeah, I like solved that problem, I was like, this is very interesting.
hmm
Um, so, for those owners who are worried about that big tax bill, especially, older owners who've had their business for a long time, you offer a structured installment sales solution. What is that?
Yeah, well, let's talk about it. Um, and just to kind of touch on a really important part of all of this, as you said, it's certainly not exclusive to the older business owner whatsoever. But we do find ourselves at this time in an aging demographic where we've had business owners that have labored their entire lives building up a business. And it's sad to sometimes see that there is a disincentive to reap the reward of having built that business for fear of the capital gains taxes that will be tied to it. So I'm really honestly privileged to be able to offer a solution that does allow them to see the fruits of their labor materialize. And so the structured installment sale, I think, is, just such a great option for these folks because of a number of reasons we'll touch upon. But in its most basic terms, it is so clean and simple. It's patterned after IRS code uh, 453 that's been on the books for decades under a conventional installment sale. And then folks that probably are familiar with that situation, it really is always been a really nice way for a seller to realize that deferral of capital gains taxes and the way it was intended for under the IRS code, rather than taking the entire proceeds of the sale that year and having to report the gains on that. The installment sale concept, again, that's been around forever, is intended to allow the seller to spread that sale over a period of years and only then report the gains from each year, which does an incredible job to mitigate taxes, create tax efficiencies. But regrettably, the conventional installment sale then puts the seller in a very kind of unattractive situation of then being dependent on the buyer's long-term viability to make those payments. And sadly, so often what does happen, even with the best of intentions, being up the deal, is that the buyer will encounter things down the road, not anticipated or whatever, that keeps them from fulfilling their obligation to make those future payments and leaving the seller in a very untenable and undesirable position, sometimes to have to take a business back that they really didn't want to anymore. So thankfully, our really great friends at MetLife had seen that situation, and, as the mother of all necessities, right? Inventions are what we've built our country from, saw that there was a really great solution that they could provide. Keep in mind, and I'll probably repeat this a couple of times, when we talk about MetLife, we're talking about an institution itself that's been around for 157 years. It's With that, it means that it's withstood every market crash that's ever occurred in this country, beginning with the first in 1929. And just even in our lifetimes in this century, we've had three: in 2000 with the dot-com crash, 2008 with the real estate bubble crash, and then again in March of 2020 with the COVID crash. During that entire time, of course, the 157-year history, it has met its obligations, and thankfully it also is scrutinized by every state, all 50 states, and rating agencies from AM Best to Fitch to Moody's to Standard & Poor's, and it has all of the highest possible attainable ratings. So MetLife now, in this situation, the installment sell, rather than the seller now, having to be dependent on the viability of the buyer to make those installment payments, MetLife steps in and substitutes that buyer's obligation. Now you're looking at, as a seller, at an institution that has that such wherewithal to have the confidence in knowing that you're going to get those payments.
Gotcha. No, that's great. And the longevity piece is really important. Been reading a lot of history of like kind of financial institutions over the US, and right,
Yeah,
they close. Like even if you look at, we're at kind of historically low levels of large financial institutions closing, but
yeah.
still every year they go away. And so being backed by a strong institution is really important. Certainly stronger than any individual buyer you might
Yeah,
come up.
and if I could add one little aspect to that, you're right. I mean, thankfully, the failure rates of companies at large have been reducing, but you know, I dare say that the failure rates of life insurance companies specifically has historically always been very minuscule for the reasons that I stated. They're so heavily regulated, they're so heavily scrutinized, they're obligated to be extremely cautious on where they place their own investments. And, a company such as MetLife that has an A plus superior rating is telling us that they're in it for the long haul. And have proven that. So it's a real security risk component that we are able to very comfortably talk about.
And who is this solution? Like, who do you think this applies to? I imagine there's different types of reasons why someone would want this. As a business broker, I often run into, everyone wants all the money right now, typically.
Yeah.
But, could you walk me through kind of the different personas of like who this solution applies to or has benefits to?
Yeah,
Um,
for sure. Thank you. And I'm going to comment on I want the money now, because sometimes that
yeah.
is, but sometimes on a second look, they realize maybe I don't, right? But in this instance, I'm a little careful, I hope you appreciate, to try to create too much of a defined box, because as soon as we do that, then we start to forget or look past those that may not have fit squarely in that box. And I don't want to do that. But in general terms, really good candidates are those that are either looking to exit their business and or property. And sometimes that's the same person if the business owner also owns the building, for example, in which their business is operating from. So it could be two bites at the apple for a solution for them, or either or type of deal. But as to a business, focus on that for the moment. It's really driven by the type of business structure. And quite frankly, if it's a business sale of a lot of inventory or equipment, it may not be as good a candidate as if the sale is more heavily oriented towards a goodwill sale. Okay. Because if you think of the depreciation and stuff that you can deploy on equipment and inventory, that kind of negates some of the capital gains, exposure. Whereas but you could have a combination of a business deal involving goodwill and inventory or equipment, of course, right? So it's really, I would say, if we're looking to say what might be a good fit, if there's a good goodwill component to the transaction, irrespective if there's also equipment inventory, we should consider it a candidate worth looking at. And if it's a sale of a property, there it's a really comes down to more so just, how much do we have in the way of cost basis and capital gains exposure. I will share with you that MetLife itself, not Bob, has kind of helped us by identifying also where the playing field is really for the SIS, if we can call it that, structured installment sale. The playing field is mostly really they'll start wanting to look at cases where they're wanting to structure 500,000 or more. Okay. And then they will even admit to certain occasions they might be willing to take a look at something a little less than 500,000, but for their guidelines, underwriting, et cetera, they've kind of looked at 500,000. And then on the other side of it, and the kind of cap on it is right around 5 million, structuring 5 million, because once you get a little over 5 million, some additional taxes come into play that tend to maybe cause the SIS not to be as beneficial. What does that mean? That means you could still have the sale of a business of 8 million, 15, $20 million, but maybe where you want to really look at the SIS would be up to that a little over 5 million. So it's not to say that you can't use the SIS on a transaction exceeding 5 million, but that kind of gives you a little bit of some parameters of when to consider utilizing it.
So deals with a lot of goodwill and deals with 500,000 to 5 million, kind of anyone transacting in that range. Now, I'll bring this up as well because I think we focus on people who are selling, who own the property, who are also trying to avoid like a big capital gains bill. But I know you've mentioned this is also a great tool for buyers.
Yeah.
So why do you bring it up as, to me, it's like, oh, this is something for sellers, but I know you've explained like this is a great tool for buyers too. Why is that?
Yeah, thanks for bringing that up, Joe, because yeah, kind of intuitively as you kind of begin to digest this product and understand the mechanics of it, it kind of automatically inures to the thinking, oh, this is great for the seller, while, as you said, maybe kind of overlooking the benefit it can provide to a buyer. It really could help a buyer to distinguish themselves from any other competing buyers to a seller of a business or a property, because we're also kind of predisposed to just throwing cash at offers, right? We're just kind of maybe intentionally or otherwise realizing, well, it's their problem to deal with the tax problem that they're going to have
And
from this sale.
yeah, I think a lot of the buyers and brokers, they just want to pull on that price lever for
Yeah.
every solution. I'm going to have to pay so much in taxes. Give me more upfront. Any problem is like, let's just adjust this price up and down. And
Yeah.
so I think
Throwing
for me
cash
as
at the
brokers,
problem this is where the buyer can step in and say, look, I can see where this transaction could potentially put you in an undesirable tax situation through this, if we go the route of a all cash type of transaction. I've got a solution for you with my offer that will help address that. Number one, it really, I think, again, is going to distinguish that potential buyer. It's also going to create its own level of goodwill to the seller. Like, wow, this person, man or woman, is really given some real thought to this. And frankly, some sellers may not want to hear this, but maybe they will. That buyer can potentially come in with an offer that's a little bit less than, say, another all cash offer, because of the fact that the overall tax savings is going to or result from the SIS implementation is going to be better for the seller in the long run than potentially a cash offer that's higher. So it gives the buyer a chance to maybe come in a little bit lower, but also provide a solution that's really going to stand out.
yeah. And that gives the opportunity for a buyer to say, hey, I understand your position
Yeah.
and I care about you and the company. And I think it provides a lot of legitimacy for a buyer to say, I actually kind of think through these things. I understand the business. I want to make sure it's in a good position long term. And I'm equipped with more knowledge than just someone who's just like, you know, I'll just give you more cash to go away.
Yeah.
Um,
Now,
on,
if I could, and if this is a good time to maybe interject, um, some of more of the mechanics of it. Okay.
yeah,
The portion that is going to be placed into the SIS, okay, that has to be available at closing. to be put into the escrow. Okay. If you just, for example, if you have a $2 million deal and let's say the buyer is coming with 1.5, but maybe is asking the seller to float a promissory note for 500 of the remainder, we can make that deal work. It doesn't, in other words, the buyer does not have to come always fully financed for the whole transaction. Okay. I just wanted to bring that up.
Yeah, so I mean, could we kind of continue on that thought of kind of going from buyer offer through post sale to like
Yeah.
understand mechanics? And I think I'm really curious to kind of walk through this example where, so I'm a buyer, let's say the seller is going to accept my offer regardless,
Hmm.
right? Let's make that
Hmm.
assumption. I'm going to offer a lot of the price up front, whether it's structured installment sale, but I guess there's a portion that I'm not going to fund up front. So then if you could kind of walk me through the mechanics of like what I fund to who and then trace that cash being outlaid to the seller.
Yeah, 100%. Thank you, Joe. Yeah, just conceptually, what will happen is, and I may add a little bit more granular info that
Please
than
do.
you want,
Yeah.
but it's important for both parties to kind of know what to anticipate. Because we're assuming this is going to involve an SIS, among the things that will happen is that I will meet with the seller and I, by necessity, but because of the guidelines, need to go through a suitability form with the seller that in effect really says to MetLife that this seller has enough sufficient other assets available to them in the event of a unforeseen hardship or emergency, that they have liquidity to look to for other assets because the money in the SIS is locked up. It's illiquid. So we go through that form, suitability form. There's thankfully this kind of speaks back to how clean and simple this is, especially against some of the other options we might talk about. A few other forms, they're basically, pretty straightforward. The seller, I would have to meet with the seller too. And the seller is essentially proof of funds, proof of resources type of thing. I do have a conversation with the seller at the time that educates them about the process, also with the nuanced of knowing that, yes, we're setting it up, we're putting it with an incredibly strong institution, MetLife. There is what's known as a contingent liability attached to the transaction. In the very unlikely event a MetLife that has sustained 157 years of existence with the highest possible ratings were to potentially go out of business, to default, then there is a contingent liability to the seller. Now, that can sound a little scary, meaning that, that obligation would then fall back on the buyer to make those future payments. But again, if we're given the opportunity for a proper education, I'm never going to say never because that's irresponsible. But truthfully, if a MetLife were to ever fail, it's probably financial Armageddon for the country, honestly. So we can get past that. But anyway, then we go through the forms. I submit them to MetLife. Their team reviews all of the documents. Takes 3 to 4 days usually for them to, if we've done everything right, they may come back and say, hey, can you get this clarification? Anyway, as we're preparing now to go to closing, then we also have an understanding that at closing, that amount that we've earmarked and set aside to be deferred from the sale, and we have a lot of flexibility about how we can set up the payment schedule. This is an annuity product through MetLife. So we can start payments in a year and then have them run consecutively each year, monthly, quarterly, annually, however they want, semi-annually. But that will have already been all decided. And then at closing, a separate check is going to be made payable to MetLife Assignment Company so that there's not what the IRS will call constructive receipt of the funds by the seller, which would blow all this deferral business that we're talking about. And then after that, the seller and the buyer eventually will get a contract issued by MetLife that spells out their obligation to make the payments. And it's pretty clean. It's pretty straightforward.
So to recap, to make sure that I'm following, the buyer pays you MetLife. MetLife has a structured agreement with the seller for an annuity and basically says, all right, you're not going to receive a check right now, but you will receive a check from MetLife in a structured way that benefits your future plans in a form of an annuity. And we MetLife are backing that. There's a contingency, but essentially you're trusting us.
Yeah.
And I think that part, and correct me if I'm wrong here, because I want to kind of get this comparison into this conversation, is
Yeah.
compared to seller financing, what I hear all the time is like, how do I like I want a clean break? How do I know the seller is going to pay me the seller financing? It sounds to me like you get a clean break, you only deal with MetLife, and MetLife has a lot better chance of being around for another 10, 50, 100 years
Yeah.
than, the buyer who, like, they may have weather an economic downturn for MetLife probably is like, okay, like we're still MetLife, we'll be here, that's no problem.
Right.
Economic times, but that could be really, really detrimental and like a default on seller financing. Is am
Yeah.
I missing something here in that
No,
comparison?
you hit it right on the nail. And if I could just kind of accentuate what I've not really done a good enough job just yet, trying to share, is that the way that we can set up a payment schedule through MetLife is fortunately pretty flexible in the sense that, we can, if the seller were interested, we could have those payments go out for 30 years if they wanted. Okay.
Cool.
What they've done is now created a guaranteed stream of income for the for long-term future with certainties tied to it where they can plan around it and exceptionally good tax efficiency, tax savings tied to it. And they have a opportunity to have and then furthermore, every one of these SIS annuities also has a beneficiary feature to it so that God forbid, if the seller does not survive the entire duration of the guaranteed payments because of that beneficiary feature, whomever they had designated as their beneficiary or beneficiaries will then continue to receive those payments. So then it also, on top of everything else, creates a level of comfort to the seller that they've created a financial legacy for their loved ones in the event that something unfortunate were to happen to the seller. So that's another oftentimes forgotten component of it.
I'm glad you mentioned that. I
Yeah,
know that a lot of owners have family, like this is like a legacy for the family. And but sometimes those family members, and I've seen cases where it's like, well, of course, my son or daughter, you know, they're a pilot now, they're a lawyer now, they don't want to run this business, but the business
yeah,
is still valuable. I want to make sure that they benefit from this as like an asset for the family.
yep,
It sounds like it provides a way to not guarantee, but lock in some security for families to do that without the son or daughter having to be like, okay, I gotta check the P&L every month now.
right, exactly. And that's the thing too, is that it is going to be a fixed annuity. Right now, the way that this is structured with MetLife for them to get the blessing, if you will, through private letter rulings with the IRS, and do all the vetting that they did to, as you would expect a company of their standing to make sure that they've done all the R&D and the compliance work beforehand for it to enter the marketplace. It is in the way of a fixed annuity, which, you know, means that it's not going to matter who's in the White House. If there's wars breaking out around the country, it's how the financial markets are doing, et cetera. This is something that is going to be so certain that they can plan around and depend on that it really brings a lot of comfort to folks.
Absolutely. Well, Bob, I really appreciate you kind of showcasing this solution, explaining who it's right for, how it works. Any other kind of closing comments as we wrap up here? Words of parting wisdom? And then also, if you could please let people know how to get a hold of you to learn more or to implement this for themselves.
Yeah, of course, Joe. Again, thank you so much for this opportunity.
Thank you.
I feel really fortunate to kind of, in a way, feel as if I'm a little bit on the frontier, introducing because while it's been around for a little while, it's still at this point, it's quite not quite as well known as some of the other alternatives. And frankly, if we have an opportunity some other time, or if we get into a situation, we can certainly do the diligence of comparing it to some of the other options that are available. But I really like, and I feel super comfortable when we talk about it versus other options. I really do. I really like how the SIS stands up against other options. But yeah, I think if you just if you are, looking at a sale and you already know, or your tax advisors are telling you, hey, we're going to have an issue here. I think that's the time where we just start saying, hey, why don't we kick the tires a little bit? Let's see. Let's kick it around. Let's see if this is a good fit or not. You know, the way we operate is, and I'm sure you do too, we won't waste your time if it isn't. If it isn't a good fit, then, we let folks know that so that they can continue on. But if it has potential, and the way to reach me if that situation arises, Joe, is you'll see my name mostly is officially as Robert Caples, and I am with Ringler, Ringler. So our website is ringlerassociates.com. You can find me on my profile page there. But also, I am available at the following email address: rcaples at ringler, and then the word associates spelled out completely, .com. rcaples at ringlerassociates.com, and my office number is 281-937-9090.
I'll make sure in this segment to put that in text over my face, and so everyone will
Thank
get
you.
it.
Thank you.
But Bob, again, super grateful for you coming on and talking about this solution with me. Hopefully we'll get the word out to more people of what you do and how it can benefit them. So again, thank you so much, Bob. And for everyone out there, it's Bob Caples.